What's up, my friend? Back to you to talk about banks and credit unions. What are they doing? That's what we're going to try to find out here today as we go through all of the different things that they are up to and what it's going to mean for you in particular. If you think about what's been going over the last, I don't know, call it since 2022, we've run into a fundamental issue of being in the fog. And think of yourself as being in this foggy space, and you're looking for a place to find some level of clarity. So guess what? You got to get out of there. You got to get a rope, and you got to shine some light on some things that will hopefully get you out of there. And that's my hope today, is shining some light on the fog that's going on within the market, some fog that's maybe taking place in your own life. Who knows? As we go through it. So that's the hope here today. Look, I am a big advocate of music. I love music. Probably listen to it a little bit too much, but I'm a big fan of jazz, particularly Chris Bodie. He's one of my favorite composers out there. He loves to do the trumpet. And if you do get a chance, got to go check out his concert. It's pretty awesome. Shameless plug. But you have all these different elements. You've got rates, you've got liquidity, you've got credit, regulation, and just the capital as a whole. And when they're all working really well together, it's like this fine-tuned orchestra. And so that's what we want to try to do, is really tune things up today and take all these different pieces and elements of what we're doing and hopefully make it sound a little bit more palatable. So let's look at the market pulse for credit unions and banks. The first thing in Q1 2025, CBRE and the lending momentum showed that the index jumped 13% from Q4, a whopping 90% year over year. What does that really mean? It means the banks, credit unions are lending a little bit more than they have in the past. And that's a big deal for you and me. Banks lend non-agency closings. It really is grabbing about 34% of the market share. So if you get a big pie chart, about 34% of that, a third or so of every and all lending that's taking place is happening through banks, whether you like it or not. Spreads, again, that credit spread. So if you figure out an index, you've got maybe the Treasury or Prime, and that spread that they're going to charge on top of that, that's been pretty wide for a while just because the interest rates have been so high and people are trying to get some more money out of you and I. But they've actually dipped about 29 basis points over the last year, even the last 6 months have really tightened, which means the rates are lower than they were, at least in a short-term fashion. And on the flip side, delinquency rates have actually risen. We shouldn't be shocked by that. I mean, you look around and you start to go, okay, what's going on? And we knew that delinquency was probably going to take place as well. Credit unions are growing total assets and loan volume in Q1 2025. Credit union systems hit about 2.37 trillion. That's up about 2.6 to about 3.3% for loans. Credit unions are great to work with. There's more flexibility. They have more tax advantages. Banks are really happy with that, by the way. But they are great to work with because usually prepayment penalties are lower and they tend to be better on pricing. Shh, don't tell anybody. Now, a few things I want you to take away as we try to understand the banks and the credit unions. One number is anticipate bifurcation. What is bifurcation? Well, if you're going to go the traditional route, which is you're going to go down the bank route, trust me, there's going to be more red tape. It's going to take longer. Things are just dragging out. You need to be prepared with the plan B. You've got to be able to come in and say, okay, I'm going to probably go with a private route. Have something as a backup plan. Otherwise, you're going to be stuck and frustrated and not know what the heck is going on when they come back to you and say, we don't think that we're going to do your deal. And you're going to just pull your hair out if you're not prepared. Number two, to help you and I out, is lean into clarity of metrics and risk metrics specifically. Look, when you come in, you need to be prepared with what is the loan to value that you believe that you're out? What's the debt service coverage ratio that you think you're at? What's the exit cap? And what's the worst case scenario? Take some time to stress those things out. What does it look like on the upside, the downside, the worst case scenario? You will look like a rock star if you end up doing that simple little thing. It will help you get over the finish line. Number three, communicate with clarity. Look, we're going back to grade school for you and I. Just listen well, follow up and follow through, do what you say you're going to do, get the information in. I deal with this all the time. You've got to make sure you're the one following up and following through and getting it done. That's going to create confidence, and it will help you get a lot more clarity when you're dealing with people as well. Number three, or I should say number four, should probably get my numbers right. Watch for capital windows. The $7 billion out of 4.8 trillion, right? That's 20% or so, if I'm doing my math right. It's coming due. So guess what? There's a ton of loans that are going to come due. You don't want to get stuck in the cog and go, what in the heck is going on? Start early. Set your clock back early so you can get in line and be early when you go get your iPhone. No pun intended, but you get your loan. And I think that will pay off in the long run. So if you think you're coming up in a year, you got to start now. I know that sounds crazy, but do it early. It'll make your life so much easier. Trust me, my friend. Number five, simplify, structure, reduce the friction, and preempt issues. I remember when I was trying to go into college and figure out what I wanted to do, and I sat down with my brother-in-law. He was going to an engineering school, and I said, yeah, I'm thinking about doing an engineering. And I remember him opening up these books, and it just was so overwhelming and so complicated. And I just went, I don't want to do engineering at all. It was too complicated for me, at least. I'm a simpleton. You need to take some time to simplify things. You've got to boil it down to the brass tacks, pull everything up into one sheet. Otherwise, you're going to lose them and lose them fast. So make sure you simplify things for the lenders. And finally, next steps. Number one, audit your pipeline for 2025 maturities, refinances. Make sure you know what's coming up. Build a communication plan, share it with the lender partners now. Number three, stress test deals with downside metrics. Make sure you're really in a position to show them what's going on. Number four, prepare fallback capital partners. You got to do that. You got to have your plan B. And finally, keep your story simple, compelling, and credible. If you do these things, guess what? You're going to be able to have more confidence that you're going to get your deal over the finish line. You're going to have more clarity. Ultimately, you're going to be able to focus more of your time on the thing that matters most to you, your vision, which you're trying to accomplish ultimately for your benefit.